By now, we know something surprising about the modern financial system. Three asset managers appear again and again across the corporate world: BlackRock, Vanguard, and State Street. Together, they're often called the Big Three because their funds hold shares in thousands of companies: technology giants, banks, energy corporations, retail empires. Across the global economy, these three firms repeatedly appear among the largest shareholders, which naturally leads to an important question. If these companies own large portions of the stock market, who owns them? At first glance, the answer seems simple. Public companies have shareholders. Investors buy stock. Those shareholders own the company. But when researchers started examining the ownership of the Big Three, they discovered something more complicated. The structure of ownership looks less like a pyramid and more like a web, a network of institutions, funds, and investors all connected together. To understand that structure, we need to look at each company individually, because the answer is different for each one. And the first example is perhaps the most unusual. Unlike most corporations, Vanguard does not have traditional shareholders. There are no outside investors demanding profits. Instead, Vanguard operates under a unique ownership model. The company is owned by its funds, and those funds are owned by the investors who buy them. This structure was designed by Vanguard's founder, John Bogle. Bogle believed investment companies should serve investors, not the other way around. So he created a structure where the firm itself would ultimately belong to the people investing in its funds. If you own shares in a Vanguard index fund, you indirectly own a piece of Vanguard itself. This design allowed Vanguard to operate very differently from most financial firms, because it does not have outside shareholders expecting profit growth. Instead, the company focuses on reducing costs for investors. Lower costs attract more investors. More investors increase the size of the funds, and larger funds allow Vanguard to lower costs even further. Over time, this structure helped Vanguard grow into one of the largest asset managers on Earth. But BlackRock operates differently, and its ownership structure reveals another layer of the financial system. BlackRock is a publicly traded company. That means its shares are bought and sold on the stock market. Anyone can technically purchase shares in BlackRock. But when researchers analyze its largest shareholders, something interesting appears. Many of those shareholders are other asset managers, investment funds, institutional investors, pension funds, insurance companies, and yes, sometimes even funds managed by Vanguard and State Street. This creates a complex network of overlapping ownership. Large institutions invest in each other. Funds hold shares in other funds. And ownership spreads across thousands of investors. BlackRock is not controlled by a single individual or family. Instead, it is owned by a broad mix of institutional investors and shareholders, which brings us to the third member of the Big Three, State Street. State Street is also a publicly traded company. Like BlackRock, its shares are traded on the stock market. And like BlackRock, its ownership is spread across many institutional investors, pension funds, investment firms, insurance companies, mutual funds. Again, the same pattern appears. Ownership distributed across a network of financial institutions. Some of those institutions even manage funds that invest in each other. At first, this structure can appear confusing, but it reflects something important about modern finance. The global financial system is not controlled by a single owner. It is a network of institutions.